As we continue with our 2020 Investment Summit, next is Jeffrey Marcus from TPA Analytics. Jeffrey Marcus, president of Turning Point Analytics, turningpointanalyticsllc.com. One of the big questions that has been swirling around this market over the last couple of years in particular is that exchange-traded funds, ETFs, this was the new thing, right? The new shiny toy of investing, and basically you can't really beat the index, so just buy the index, be a passive investor, buy these ETFs. It's a no-lose proposition, and I've been arguing for the last couple of years that ETFs are a danger ultimately because they lever the market in a different manner. So when people start selling these ETFs, all the underlying stocks that belong to those ETFs also get liquidated. And when we have a correction in the market, it will be magnified by the liquidity vacuum that shows up from these ETFs. Is this what we have seen over the course of the last, couple of weeks in the month of March in the markets where we just had this immediate decline of almost 25%?
I've been actually looking at this question since about 2016. There's three basic problems that I always had with ETFs. So let's you and I first say that ETFs do not have a negative constituency. So if you look at the firms that create ETFs, they're happy because they're grabbing huge amounts of assets and they have huge amounts of fees off of that. Mm-hmm. So you're not going to get any arguments from funds that are creating ETFs and garnering assets. Likewise, we don't need to talk about this in this section, but index funds, exact same thing. You're not going to get any arguments from those people as well. There is a huge difference between ETFs and index funds. We can go into and we can probably touch on that. The other people that it's good for is investors, and there's almost no question about that. I mean, ETFs give people simple way to buy a diversified portfolio as if they were buying a stock. So diversification is great. There's nothing wrong. By the way, if you haven't noticed, I'm going to tell you all the good things about ETFs, then we're going to dive into the problems. And ETFs have low management fees as well. So if you want to pay 25 basis points instead of over 1% to have your money managed, then ETFs make sense. And also the last thing is you can trade ETFs all day long. Whereas if you want to buy a mutual fund, you only get one price, that's the closing price. The last constituency, which probably kept this thing going as long as it's been going, are the authorized participants. Now that gets a little bit more technical, but there are firms in the market that are authorized to create and redeem an ETF. So in other words, those are the people that take the underlying stocks and create an ETF out of them. So they take 30 stocks, and from those 30 stocks, they create an ETF. But also what's necessary sometimes in the marketplace is redeeming, which means those people will then take the ETF itself and break it down into its underlying components. So there are people in the marketplace, those authorized participants, and their job is basically to stand ready all day long to do an arbitrage between the ETF price and the underlying holdings in that ETF. So if the ETF is trading a little bit above the 30 stocks, let's say, that are in the ETF, they'll sell the ETF and buy the underlying stocks until that price discrepancy goes away, and then they make the difference. So they're making a profit out of that arbitrage every time. So just to summarize, there really is no one to argue against ETFs. No one. So what you and I are discussing here is not that there are people in the marketplace that don't have great things happen to them because of ETFs. I think what you and I are arguing is that what there's a problem with is the market structure that's created by the huge amount of ETFs, and I will just throw index funds in there for fun, but there's a huge problem with that. And so that's really what we're talking about here.
Let me ask you a question, Jeffrey, about that in particular, because yes, there are lots of good things about ETFs. Yes, they do make things simple. Absolutely agree with you. And over the course of the last decade, the markets have simply just gone up. So indexing and passive investing kind of became the mantra for the markets. You don't really need to actively manage your money, just buy an ETF, be passive. One of my arguments has always been that passive indexing is fine and passive ETF buying is fine. But when we get into a market correction, passive investors tend to become active sellers. Despite the best of intentions, their emotions tend to get the best of them. And one of the concerns is, and this is, I think, one of the things that is one of the problems of the ETF market is we develop so many of them, right? There's 5,000 ETFs globally. There's 1,750 ETFs in the US. And of the 1,750 ETFs in the US, 175 of them all own Apple. So, when that selling begins on those ETFs, it further pressures the underlying stocks. And is that part and parcel of what catalyzed such a rapid and sharp decline in the markets during the month of March?
I think there's no way to prove it, but there's a litany, which I've gone over in my reports to my clients, of evidence that can be pointed to show that the ETFs have made the markets way more unstable. And a lot of the instability only happens when the market declines. So the three things I think you can group the problems under are the creation redemption process is advertised as simple, and it's not. And that's been proven by a number of studies. One study basically looked at, and this was a study done by actually the exchange themselves, the SEC. They looked at how many cancel and replace orders. That's how when traders are trading, they have to move the prices around. How many cancel and replace orders are necessary to create an ETF versus trading a stock? And the answer is about 20 times as many. So yes, it's way more sticky. It's way more complicated to create and destroy an ETF. The thing I think that you were getting at was what happens when all the stock, especially of specific companies, are stuck in ETFs. And one of the things that TPA has created is called an ETF illiquidity score. It's interesting that a lot of this information, the numbers that I need to create this, are not easy to get. And I think that goes back to what I mentioned before, that there's no constituency that doesn't want ETFs to happen. I looked at all stocks that are $2 billion market cap or greater. And if you look at all those stocks and there's a way to get the percentage of their outstanding shares that are in ETFs. So let's just say IBM. You get the percentage of IBM shares that are in ETFs. And then if you look at the daily average volume of IBM, what I do is I create what I call an ETF illiquidity score for IBM. So how many days of trading, average trading, are in ETFs for IBM? And those numbers are fairly high. You would be amazed at how high those numbers are. So what I did is I looked at every time the stock market has declined 5% or more since 2012. And then I looked at those stocks that have a lot of their shares of stock in ETFs. And you may or may not be surprised, but for a while, there was no problem whatsoever until we got to a critical mass of ETFs. Now, there are $4.5 trillion right now of stock in ETFs. And Bank of America has predicted that will grow to over 5.3 trillion by the end of 2020. So that's an awful lot of stock value that's stuck in ETFs. So if you look at what's happened in the last 4 or 5 declines, especially the declines since 2019 of 2020 to now, you will see that those stocks that have huge amount of their shares in ETFs have underperformed the S&P 500. So, for instance, if you look at the stocks that have 10, 20, 30 days of their outstanding shares in ETFs since 2019, those stocks on average have underperformed the S&P 500 by 3% since February 19th, since this whole decline began. So as you said, the whole idea is there's a problem here. We can't we can't actually check it off and say, hey, the fingerprint's right there. But we can definitely look and see that stocks that have a huge amount of their shares in ETFs have underperformed the S&P 500 in this huge decline. And I think it's going to what you're saying right now, is that there is a certain amount of illiquidity that's locked into the fact that these are not just simple products. These products have to be created and redeemed over and over again. Does that make sense?
Absolutely. So that leads me to this question about, now we kind of understand potentially what the problems are with ETFs. What do you think this means maybe for the future? Are we going to see potentially some SEC actions at some point? Generally after every time we have a crisis, whether it was the 2000 .com crisis or the financial crisis, right, after the fact, the SEC leaps into action to solve all the problems that caused the previous event. Do you think we're going to potentially see tighter regulations and maybe some tighter restrictions on how ETFs are formed and managed, particularly when it comes to more esoteric investments like, say, Bitcoin?
I think they should. I don't know exactly what those solutions would be. If you think about it, again, I go back to the constituencies that are benefited by ETFs. And so the question is, how are they going to do this? So I guess they could restrict the number of shares of any one stock that go into ETFs. All of these things would make it more complicated for the entire ETF market and probably for the entire indexing market.
Well, let me maybe ask the question a different way.
Sure.
When we look forward now over the course of the next 3 months, 6 months, 9 months, investors that have been buying ETFs and thinking they were kind of the easy way to invest, you're buying whole baskets of stocks, a whole basket of indexes, et cetera.
Right.
Do you think that potentially we're going to see a migration back to people going, instead of me buying the whole basket, I'm going to buy these selected companies that are really of deep value now, and see, at the peak of every market, we always have the shiny toy, right? And 2000 was .com stocks, and 2007 it was real estate. Now it's ETFs and robo-advising. Do you think we see a rotation back towards investors becoming more selective about where they invest?
I do think that. It's interesting that one of the things about this shiny toy is it actually drove the market to its highs. So if you think about it this way, Lance, if you think about ETF and in passive investing to its extreme, the question becomes, who's looking under the hood? Like, if everybody was indexing and everybody just bought ETFs for exposure, who would actually be analyzing stocks? Who would actually be looking at individual companies? And that becomes the problem, because if no one, the reason that the market is efficient is because people are digging in, analysts are looking and seeing what's in income statements and what are the products like, and they're doing some research out in the market. If nobody is doing that, now of course people are doing that, but if you take this to its extreme and no one's looking under the hood, the question is, companies can do whatever they want to do. Right. And is that really what we want to do? The other thing is, I think you brought up, is that when this happens, we create huge value, because there are stocks now that maybe won't be in ETFs. And those stocks have always then had less demand, because as people have bought ETFs, those stocks in ETFs have been in demand. Now the exact opposite, of course, is happening, because as we sell ETFs, then those underlying stocks have to be sold. And if the problem that I brought up was ETF illiquidity of stocks happens, then those stocks get sold down. But there are stocks, like you said, value stocks have underperformed, because value stocks, a lot of them, have been left out of the ETF craze. And those stocks, so there may be a return to trying to find value, not necessarily just value stocks, but value in stocks.
Right.
By going out and looking for individual stocks that are now undervalued versus where they were historically, or the market itself as a whole, or all these different ways of looking at value. So yeah, I can see that happening, and the market could actually correct on its own. It's hard to stop a habit, right? People get addicted. Certain things are so attractive, so cheap, whatever, that people get pretty addicted to it. And it'll take some massive changes, and this could be it, actually, to make people look elsewhere.
So looking forward, Jeff, where do we go to from here?
Let's just step back for a minute, because the world, the market was going crazy and always reaching new peaks, and the knee-jerk reaction was buy on dips and all that kind of stuff. Mm-hmm. But really, the economy was in pretty good shape. That's what's so surprising about how quickly this went down. The economy was in good shape. Unemployment was low. Companies were doing well. People were feeling pretty good. Confidence was at sort of all-time highs. So that didn't just go away, really. I mean, companies are still in good shape until this all happened. And the question is really, how long will this go on? So my answer to people is that, in conjunction with what we were talking about, go back to a little bit of what Peter Lynch used to talk about when he used to talk about looking at stocks. Do some homework on your own. Stick with those things that you know best. If there's something that you're in, whatever business you're in or whatever area you're in, maybe you live next to the headquarters of a company, and you notice that, this is the old story. The parking lot is full. People are driving their better cars parked in the parking lot. Whatever that thing is that you know better, make that your advantage. You do a little bit of work on the outside. It's okay to take a little bit of risk and not just get exposure to the market. Again, I don't think ETFs are going away. I think that would be a mistake. The same way that mutual funds didn't go away. I don't think indexing is going away. But I think that there probably is a happy medium. And I think what happened is, probably over the last 2 years, we probably slipped over the edge of what was okay. And I'm with you on this, that the 30% down in the market in a month is probably somewhat due to what's going on right now, our pandemic, but also somewhat due to how the market is now constructed because of ETFs and products like that. What investors should do is take a step back and have a more balanced approach, where all their money is not in ETFs or index funds. Maybe there's a place for that, but also there's a place for using your head, doing your own analysis in a smart way, having a disciplined approach and all that. But maybe trying to see if you can find some value in the market.
The advice there is that we're coming back to what investing is actually all about, which is buying something cheap and selling something rich. We always just tend to forget about the selling part, right. As markets kind of get carried away. And, it's interesting you brought up the statement a minute ago, is like going into this, the economy was good. We had record low unemployment, record high confidence. What's interesting about that statement is that, yes, that was the case, but that is always the case when you're at the peak of a market somewhere, absolutely. Right? And it's the reversions that kind of reset the table. And we always forget about that process. And, right. When we go through this reversion process, people go, well, I'm out of the market. I'm never going to come back. I'm never going to invest again. This is the psychology that invades the market across time. And as you're talking to your subscribers at, Turning Point Analytics, LLC.com, going forward, what's going to be kind of the things you're looking for where this, crisis may be starting to turn around and we start getting our feet back on the ground?
What I've told people a lot, I do a lot of technical analysis as well, and we are nearing the point of real support around the 2110, 2180 level. That was the breakout out of the last serious decline after 2016, after 2008, when crude, as you remember, halved in price, and people began to worry about the junk bond market and everything and how crude was going to affect everything. Then crude bottomed out in February of 2016, and the whole market turned as crude bottomed out. And then we saw a bunch of breakouts from the stock market. And when you look at long-term charts and you're trying to figure out where is there some kind of support, that's kind of what you look at, going back to long-term breakouts. And I've been telling my clients, a lot of people were talking about 2351 on the S&P 500 as a place to look. That was the low on Christmas Eve of 2018 when tech stocks were getting hammered. And I told them that was too close. That was not the place to go. And actually, it's interesting that the S&P 500 this morning, the futures hit 2174. So that right inside that band, that's probably a place to start looking. And when, for both of our investors, when they start looking again, there's going to be some huge value. And I think it's going to take a little bit of work. Our investors are going to have to go back and do some work. There are lots of stocks that are down 60%, lots. So if you look at, the S&P 1500, that'd be the 500, the 400, the mid cap, and the 600, the small cap. If you look at those stock, that index, there are a lot of stocks that are down 50 or 60%. And one of the things I also told, and I'll bring these two things together, I send people to two websites. There's a website called World Meters that looks at the coronavirus itself. And then there's another website that looks at, it's a healthcare hospital company. I can send you this link later. But basically, you can look at the actual increase in cases. And I've told my investors, some of them are larger institutional investors, that to start to look for when that's going to plateau. Because if that's the thing that's causing this, and you're right sitting at long-term support around like 2010, 2110, 2180 on the S&P. Again, that's a little wide. That's about 3% band. But if you're going to see the coronavirus new cases start to plateau at the same time that you're at the support, that could be a place to do your homework. One of the things that you mentioned before, I mean, jump into one other thing, but you mentioned that people had jumped into ETFs. One of the problems with ETFs is that when you think that you're in this diversified product, you end up putting more money, allocating more money to the equity market than you would have, because you have this overall feeling of safety. One of the things I think you're going to see, and I think you hinted toward that, is you're going to see people pull back and do some reassessment of their allocations. Because if your allocation in the equity market should be 60%, but because you're in ETFs, you're constantly 75% invested in the equity market, after this pullback, you may want to rethink that. And you may want to think about bonds or some other safer security that you can be invested in. And maybe what you also want to do is divide up your equity into some ETFs, but then let's also think about some of these value stocks, some of these stocks that are now value stocks, that have been hit really hard. I think that's something that's going to happen.
One of the problems that has come along with ETFs is, this idea of diversification, as you said. So I buy a large cap ETF, I buy a mid cap ETF, a small cap ETF, an international, an emerging market, and they're all correlated now. So,
of course they are.
Pretty much I wind up with just a big basket of correlation, and there is not this non-diversification in the portfolio anymore.
Absolutely not. There have been a number of studies, and I've seen it myself through my own work. There's been a study by the National Bureau of Economic Research. There's been another study by the OECD that shows that ETFs themselves create covariance in the market. In other words, they create the phenomena of all stocks moving in tandem. So the idea, I don't want to bring this up, but there was if we go back a little bit in history, about 12 years, we can think of another point in time where investors misunderstood that putting things in a basket does not create diversification. I'm talking about mortgage-backed securities. Right. The idea was, if we put enough mortgages into a big basket, then we're going to be diversified and we're fine. Well, of course we weren't, because real estate is completely tied to each other. So when one mortgage went bad, they all, not all, but a lot of them went bad.
Right.
And so it's the same type of thing. When you create this basket and all these ETFs are doing similar things, you create covariance or co-movement, and that's a problem for diversification. Because if systematically everything is doing the exact same thing, then it's a huge problem. It's not just me saying this. There are huge organizations out there who have done the work. I think one of the reasons that work did not reach the mass audience, not to say it's too nefarious or anything like that, is that, once again, there's no real constituency to argue against ETFs. And so a lot of this research that was done showing the problem with ETFs doesn't really get the limelight that it would if large firms were willing to, show what the problem was with the products that they are doing well at or selling or whatever.
So kind of wrapping this up, one thing that bothers me here a little bit, Jeffrey, is that, this market, we've had a very sharp decline in this market. In the month of March, the market fell almost 30%. And there's so many people trying to figure out how to buy the bottom. Those typically don't equate to what normal bear market bottoms look like. There's an old saying that bear markets don't bottom on optimism, they bottom on despair. Whatever rally we do get here, and I do agree with, this idea that we may have a short-term bottom here at 2180, somewhere around that level. I hardly suspect, though, even if we start to get the economy recovered, that we're out of the woods just yet. There's been so much damage done.
I completely agree. So let me clarify what I said. People were looking at a place, and a lot of my clients are institutional investors, so their job is to buy stocks. So that's different than an individual investor whose job is not to buy stocks. They do it for a different reason. If you look at the trend line from 3909 or March 9th, the very bottom of the financial debacle, that trend line has been broken. That trend line was broken earlier this month. That trend line has been in place now for 11 years. So when you look at trend lines being broken, trend lines sound like a kind of a fancy thing, but they're not really. Technical analysis is basically based in trend lines and all that kind of stuff is basically based on human psychology. So I agree with you completely. The overall pattern that we had in place for 11 years, the long-term pattern, and a lot of that was when are you going to buy after things go down, that has been disturbed. And so in the very long term, we're in a different place. I don't, whether we're going to have the kind of declines you've just had or not continuing, I don't know. I think it depends on what happens from here with the problem that we're going through right now. But what I was talking about in the shorter term, let's say short-term, intermediate term, was a place where the market will probably stabilize for a while. But I do agree with you. Things in the long term have changed. The damage that has been done already is not going to fix itself immediately. We're not going to see a V bottom, and then that's it. We may see a V bottom in the intermediate term. And so I think for people who are nervous or whatever and haven't sold, let's say you could either buy and whatever for a little while and hold on. But more importantly, if people have become nervous and maybe they want to do a little bit of this reallocating that we've been talking about from ETFs into individual stocks and things like that, that may be a place to kind of lighten up on your ETFs and then start to look for a place to buy some of this value which is being created. So I mean, it's a little bit of trading, but really we're talking longer term, is that might be a place to finally raise some cash and then look for a place down the road where you're going to find some individual stocks or maybe individual places where there's some value that's being created out of this huge downturn we've seen.
Jeffrey, shame on you for talking about actually doing portfolio management.
I know, horrible, isn't it?
Jeffrey Marcus, president of Turning Point Analytics. Thank you so much for joining us today. Be sure and get by his website, turningpointanalyticsllc.com. That's turningpointanalyticsllc.com. And you'll see the address right here below on the screen. And he has a special report that we talked about today on his website. It'll be right there on the front page. Just simply click the link and you'll be able to read the entire report on ETFs and specifically what we were talking about today. Jeffrey, thank you so much for your time today. We appreciate it. Thank you so much for joining our Economic and Investment Summit.
Thank you, Lance. Really appreciate it. Have a great day.
Thank you. Coming up next is my friend and colleague, Thomas Thornton from Hedge Fund Telemetry. Jeffrey Marcus, Turning Point Analytics.
So it's Turning Point Analytics, right?
Yes, sir. But
you can just call it TPA. It's fine.
Well, that's toilet paper analysis, right?
Yeah.
We got to be careful with. You can't be throwing around TP anymore. I mean, can I borrow your pen real quick, Brent?
That's gonna be a whole new field, you know.
Exactly. What's your website?
It's a long one. www.turningpointanalyticsllc.com. I can't change it. It's been too long.
Analyticsllc.com.
Correct.
If it's been that long, you could have gotten a shorter domain back then. You can't do it anymore.
I know. They're all gone. Maybe we could do is actually make the report that I send out available for people. It's actually on my website.
Okay.
As well. You could probably give them a link to that.
Yep.
I did want to I wanted you to see, as you continue to talk about this stuff, which I'm sure you're going to do, is I talked very specifically about things that I've seen in terms of bid-ask spreads widening out. I don't think this is the right venue for talking about that necessarily.
Yeah, it's a little too complicated.
Yeah. One of the really interesting things is the closing price, is that the volumes are actually moving back to the closing price because ETF managers are scared to buy stuff during the middle of the day because they mark to market.
Mm-hmm.
And that's exactly one of the big benefits of ETFs is that they trade all day long. So as all the volume moves to the very end of the day, you're basically moving back to the old mutual fund pricing model, which is
is that why we see all the trading occur in the last 30 minutes of the day?
Absolutely. If you think about it, when someone's buying or selling stock at 10:15, that's a huge risk. They've got hours before that stock's going to close, and so why not just buy at the end of the day? But my point is that you're just moving back to where we started. We moved away from mutual funds because guys wanted to be able to trade ETFs all day long, and here we are. Right now, there's I think 20% of volume is occurring at the end of the day. That's all. That's a lot of that's got to be ETF volume. So, that's it. We're basically going back to what we were to where we were before anyway. So you can just wrap it up. That's in my report. If people want to look at that, dig deeper, they can.
All right, that was such good stuff. We're gonna stick that in there anyway. We'll put a wrapper around it. We'll just put an outtake, but we'll just do like an outtake. We'll do like a blooper reel and just say, hey, here was something that we didn't talk about that you might be interested in. Coming up next is my friend and colleague, Thomas Thornton from Hedge Fund Telemetry.